Good morning, everyone, and welcome. This is Joe Scarice, co-host and co-founder of the Creative Birth Strategy podcast and house here on Clubhouse every Sunday morning, 9 a.m. Eastern Standard Time, providing education, networking, and connections. So let's get started here in just a few minutes. We'll get started. We're going to be discussing another great subject of education, non-QM lending, and the real estate investor market update. So let's invite some peeps in for some conversation this morning, insight. I'll be popping some people in here. I'll be inviting some people up as well, some great moderators as always. Have had a pretty busy week with the market. Must say it's very active, to say the least, especially in the fixed to rent space. So it's going to be a great conversation we'll put together here in just a minute. Just give me a couple seconds just to pop some people in and get rocking and rolling here in just a few minutes. All right. So what a great week of networking. I don't know if a lot of you know, I'm very much involved with the Sub 2 and Owners Club community out there with Pace Morby and sponsoring events in New York and Philadelphia, Lehigh Valley, North and South Jersey, now soon to be Delaware starting next month, Maryland next month. We're up in Connecticut. We're going to be opening something up in Lancaster area, sponsoring. I'm a big believer in educational insight, creativity. It's not about just Sub 2. So very excited about the relationship and the collaboration that I've had with a lot of the Owners Club leaders that are putting these events together. Yesterday, I was in New York City at 110 Fifth Avenue. I had about 100 people there, just packed, talking about capital raising, talking about investment. The excitement in their eyes and the collaboration of this community is really a lot of fun. So I tie that into a lot of the events that I go to and support. And there's an opportunity to support or sponsor an event with anyone here listening in. I'm here to do that as long as it's directed toward the real estate investor, directed toward education, and also has a high level of integrity and the intentions are real. So I want to thank everybody for listening in. And again, we'll do a little update here of what we're doing in the market right now, and then we'll kind of tie it back into our discussion today on non-QM lending and the real estate investor, the market update. So been watching a lot of, push and pull with the Trump administration and Fed Chair Powell and the Federal Reserve. It's very hard to see where it's all going to go. It's like looking through a shower drape right now, just trying to figure it all out. At the end of the day, I feel Trump's got the upper edge. I think he really wants to push Powell out. He's the one that actually hired him or signed him to this position the first round. But I feel like Trump really didn't know who was who in the first administration. So this is going to be very interesting to watch. If all indications look, we've been talking in our capital markets, we're looking probably anywhere between a quarter to a half a point rate change toward the investor if this move is made. Now, people are like, oh, that's going to make a major move for home buyers. I don't think the home buyers are going to come off the sidelines with still an inflated market. I think it's going to be an investor play for the rest of the year going into 26. I do see home buyers looking at potential flip opportunities where as price levels are leveling off because of the influx of new inventory, there might be some opportunities there for home buyers. But home buyers, typically are a spring market. I mean, there's a fall market and a summer market, but it's just a different type of person looking for a home buying experience. So I really feel like I'm seeing a lot of investors buying and renovating in certain markets, whether it's the flipped turnkey to the investor or it's kind of a move-in ready for the home buyer. Just this morning, I placed 2 more loans in for fixed to rent just this morning. So it'll be an interesting watch as this tug of war goes on between the Fed and the Trump administration. Rates did settle out at around 6.81 to 6.85 on the 30-year. In the commercial level, it's just about the same. You're somewhere between 6.8 and 7.125 right now on refinance and purchase. Construction money has stayed very low. Base rate for construction money is around 8.99 for most investors, and that's really depending on credit and the asset itself, their experience in the last 4 to 8 years in completed projects. So the money there is, to me, not expensive. Some people might think it's expensive, but they don't really understand other economic cycles. And if you have been a study of economic cycles in the last 40 years, which a lot of my people in my age bracket have been at least exposed to 2 or 3 of those. The average rate's been 7%. So this is not something new. I think we had a slight spoilage to what rates were during COVID, and I think people just can't get it out of their heads. But I think slowly people are getting back into reality to what rates are and what will look like. I mean, and if everything goes just hunky dory without any kind of major blips, I could see rates in the sixes in 26. You might see rates in the sixes before 26 if Trump decides, the administration decides to make a shift on the Federal Reserve. They're really kind of like inflation's down, but the rates haven't moved anywhere. So very interesting circumstances. So let's catch up on some articles that I caught this week that caught my eye. Then we'll dive into the subject as well. Foreclosure filings spike in the first half of 2025. I did post this article. A lot of the markets are no big surprise. Obviously Florida's in there, South Carolina, Nevada, Delaware, Illinois. I mean, Ohio's got a tick up. New Jersey's obviously in the heat. Connecticut's in the heat. Indiana's in the heat. Texas is there. Yeah, I mean, you're going to see some foreclosures tick up here. People overextended themselves in the American dream, as well as investors. I mean, I'm hearing cracks in the surface with some poor underwriting by some, investor lenders such as ourselves. We've been thankfully unscathed, but a lot of people's balance sheets have been pretty much hammered. So something to keep an eye out for opportunities. Also, big city residents are evacuating nationwide. I mean, people want to get back to the suburban markets. There's just as much in the suburban markets to extend to, the younger folk to the older folk now than once before, where, you had to go into the city for the arts and for the theater and for music and good food. That's all in the suburban markets. I'll give an example. My wife and I we're in the Philadelphia market. There's much more opportunities to find things to do and places to go to without going into the city. Same thing with New York. And we did go to New York yesterday and we had a great time. But, we were there. We went to a nice little cafe down in Washington Square Park. We were at 110 Fifth Avenue. Then we went back for dinner, in some old school Italian place that we're real accustomed to in the Newark area outside of New York, and had a great time. And then we drove home. But, it was just nice to have that break away from the city. And I can understand that. And, a lot of these major cities are going to have a big affordable housing push, which will blend with more of a higher to mid-end condo or apartment living. So, a lot of people want to have the open green and things of that nature. So, very interesting article. That was I don't know if that was posted by me this week, but I will put a post of that. Millennials buck rate trends and showing rising interest in home buying. I'm seeing a lot of people talk about house hacking. Again, if it's a one family, you're living with people you don't know maybe, so you got to take that in consideration. But I think there's a huge opportunity for the younger home buyer buying a 2-family through 4-family and handling and facilitating some of their overhead. So that was an article. I might post that, but that was out there that caught my eye as well. So, some really good information out there. You got to do your homework. I do post 3 to 4 times a day on articles or blogs that I write personally, and they're posted out with my Google team to the various social media buckets. So if you're not following me on one or the other, please do so you can stay abreast of a lot of these articles that we put together. So now we're going to dive into the non-QM lending space, and that's really where I sit in my lane, and I'm very passionate about non-QM lending and the real estate investor, and I think there's a huge opportunity here. And I offer courses on non-QM lending because I think it's important because I think that's where it's going to be over the next 5 to 10 years. And the industry is only not even 20 years old. So we're going to take a mover. As we move deeper into 2025, the real estate investors are increasingly turning toward non-qualified mortgages, non-QM lending solutions to scale their portfolios and navigating tighter credit markets and capitalize on evolving property trends. And, what is non-QM lending? So for a lot of people, they think it's all hard money, and they're 100% incorrect. Hard money was a derivative or a rollout from the RICO laws in the mid 80s. So hard money was a short-term derivative always. It was never a long-term derivative. So where non-QM lending is, it provides the short and the long-term options, non-Fannie and Freddie Mac, and it follows guidelines, not regulations. So there are certain things that need to be done to close a loan, but they're not as stringent as a bank or credit union, and they're not collecting all the documentation. They're not collecting tax returns or pay stubs or 1099s or tax returns. So none of that is being collected. It's very bank statement oriented, very debt service coverage oriented, very appraisal oriented, asset based. It could either be interest only on a 30-year mortgage on a refinance or purchase, or it could be 30-year fixed. You can take a 5 or 7 1-arm. And then on the construction side, the renovation side, most lenders offer a 1-2 punch where you come to them for the construction piece, and they credit you toward the refinance piece and working with them. So like if you're doing a loan with me on the BRRRR strategy, and we close that loan, I have all that documentation. All I have to do is recertify that appraisal and refinance the property, and I'm going to discount that refinance as well because I already have that loan on my balance sheet. So it is considered a no doc or low doc scenario. It usually encompasses 1 through 4 residential, 5+ units, usually up to 12 units, but it could go up to 20 depending on loan size and the credit score of the borrower. Credit scores usually start at 660, but I have programs out there that start at 620. I mean, obviously that's LTV or LTC, impacted. So like if you're looking to get 80% LTV and you got a 620 score, good luck. If you want 80% LTV on a single family home acquisition and you got a 700 score, that's possible. So you see the differences there. So that's where asset-based lending kind of plays around. They heavily look at the credit score. They heavily look at the DSCR of the property, and they heavily look at the asset itself with an appraisal. And then the 5+ units, it's all based on discretion up to 20 units and typically under 5 million. Because most people, in the multifamily space, at least at 9 units and above, are really traditionally looking at more Freddie or Fannie guideline type of loans. And it definitely does not. It does require more documentation. So DSCR loans are a game changer. They're faster closings. They're closing somewhere between 20 and 30 days. It's not a cash purchase if you're using a DSCR loan. You do require an appraisal. There's no drive-bys or imaginary stories that you come up with. There's definitely blanket loan opportunities where you can blanket property, single family through 4 family. On the 5 through 20, most investors do not blanket those properties. There is a mixed use product out there. It does need to be at least 50% residential. Some people say 70-30 in favor of the property itself. Then there's also fixed to rent, fixed to flip, and new construction. Some trends in the non-QM space, the rates are kind of just dead heat or even sometimes better than local banks. There's definitely rent growth in key metro markets. They do look at mid and short-term rentals, and it's private and institutional capital money. So, 2025 is shaping up to a year of creative capital in real estate, and non-QM is no longer a niche. It's a core financing tool for serious investors. Smart investors will partner with direct and asset-based lenders who understand the fast-moving market and offer innovative solutions tailored to investor needs. Good morning, Amy. Welcome. Brief overview, who you are, what you do, and thoughts to our discussion this morning, non-QM lending and real estate investor market update. And I do owe you a phone call host the podcast this morning.
So mute all the time. Sorry. Yes, we're going to have a call today. So, hi, everyone. I am Amy Palvido. I am the chairwoman of the U.S. Council, which is the trade association for the real estate technology industry in the United States. Also, a real estate technology project. And the real estate investor. I've been real estate since 2003. And we're talking about ideal.
Well, we could try to wait. I could try to put it together and see if we can make sense of it on this. This would be a great, yeah. Why don't we make a run at it? Let's try this out.
Okay. So, the deal I've got is in Austin, Texas, and it's a house hack slash flip. Yes.
What's the asset type?
Really nice upscale neighborhood. It's like the only in this neighborhood. I don't know how the hell they built it. Surrounded by, $4 million, $5 million homes. So yeah, a couple of exit strategies. So anyway, but what we're going to do is, like, first year while we're waiting on drawings and permitting and engineering and all the things that we need to do. And then build something new, which also will take us about another year done. So it's a weird one. It's around $1 million. It all kind of out that way.
Mm-hmm.
And probably political side is going to cost a lot. So this is Austin. More like the house. So it's a little bit more. We have it all in.
Okay, so let's get that.
2 years, right?
All right. So we're going to cut the story out and we're going to get right to the bullet points. Is that fair? You won't take that. You won't feel insulted if I'm very direct. Okay. All right. So it's a purchase price of $1 million, 4-unit, Austin, Texas. The borrower makeup. What's the credit scores of the borrower makeup?
So borrower is like 780, and we have 2 partners. So the borrower's at the really high 700s.
All right, so 780. Okay, we'll just use that. So, and I don't need the borrower name. I don't need the buying entity. Okay. Yeah, we'll talk about that offline. Purchase price is $1 million. What's the current rents?
Right now.
Okay, vacant.
Yeah.
Okay, now does it need any work to get leased up?
No.
Okay.
It doesn't.
So what's the estimated rents?
The estimated rents would be about between $8,400 and $9,000 a month collectively between the 4 units.
$9,000. What's the yearly taxes?
This is on the property or at about $20K.
And what's the insurance for the year?
Yeah, but I'm budgeting about $2,000 or so.
And it's going to take you 2 years to get all the seed money and stuff put together for the construction piece, correct?
No, 2 years to complete the project. We have the equity already for the whole thing.
Okay, so my question is, how long will it take you to turn it into a renovation loan?
Oh, a year.
Okay, so at least a year. At least a year. Okay, so in that type of situation, I would have a discussion with the client, hypothetically, to look at either a 1 or let's say a 2-year prepay. Okay, a scale down. because you're not going to do anything the first year, right?
Right.
You're really going into the second. So we have to look at the pricing as a 1 year or 2 year prepay, because I'd rather give you a 30-year mortgage and maybe even do it as an interest only, right? Because you're going to take that loan out when you're ready to develop the loan, and you don't really want to pay. You don't want to pay a penalty of 1 or 2%. Now it might be cost benefit to do that at that point, but it's a lot better than a 5-year prepay. Do you understand what I'm saying, or no? Okay. So I would probably advise either a 1 or 2 year prepay, 10-year interest only, 30-year and see what leverage I can get the property up to. Now, the concern I have is it's unoccupied. So it's immediately going to cut the LTV back, because I'm not looking at tax returns. I'm looking strictly at the income of the property producing, and it's not producing a penny day one, and maybe not till month 3. So somebody's got to carry that donkey to the end of the road. So those would be the questions I would probably be on a 4-unit unoccupied at the day of closing, no more than 70%, right? And then I got to look at a 2-year prepay or a 1-year prepay and see what that looks like with a 10-year interest only, with a 30-year amortized loan based on a 780 credit score. Because remember, Amy, on DSCR, all non-QM lenders really don't look at experience. They look at the income and expense of the property and the appraisal. So the good part is I don't have to dive into experience in the last 4 years and all that story hoopla. It's a very specific type of. So I would probably need to know the LLC name. I would need to know the borrower name or borrower's name and the percentage ownership. And this is the beauty about non-QM compared to regulated bank. And Amy, I think you'll appreciate this. We could restructure the operating agreement at any given time for the betterment of credit in DSCR, as well as fixed to rent, but sometimes it works against you in fixed to rent or fixed to flip or new construction. But in DSCR, whoever has the best credit should be 51%, and then everybody else gets a smaller percentage, based on credit score, because the best credit gets the best rate, always, at 51%. And I only have to do a data verified background check on the rest of the parties below that, okay? Or however you want to structure it, the majority owner needs to be, I would prefer that to be the best credit. And that's how non-QM lending looks like for the real estate investor today. It's all about credit score. I don't care about the story. I care more about bullet pointed, items. Does that make sense?
So in order to get the deal done, I'm okay with giving him 51%, but that was not our original agreement. He was willing to come in for less. Could we reorg it later?
I have to reorg it for the
construction part.
Yeah, you can do it. Listen, on the back end, on the construction, that's a whole separate discussion. It has nothing to do with the DSCR. One doesn't have anything to do with the other, so you can't blend the two. Right now, this is a DSCR loan because for the next year, you're going through the permit process. So you don't want to pay construction money because you don't have a construction loan in front of you today and for the next year. So you want to look at it strictly from a DSCR, 10-year interest only, 30-year AM, stretch that money out. What if it takes longer than a year? What if it takes 18 months? What if there's a hiccup? What if this? What if that? So you got to consider a lot of the moving parts. But it sounds like there's a deal here. We just got to kind of iron out how the percentage of ownership is going to look like on the phone and talk about that. And it's really not that big of a deal, to be honest with you. But I don't want to make light of the project, but I don't want to make heavy of the project, because the story in DSCR, there is no story. It's bullet points. I just let you talk, but I'm like, I got right back to the bullet points, didn't I? Right?
You're willing to go through the deal with me on air. I mean, it's like, but I think it's a really cool case for lots of different reasons, right? So, and I'll tell you, everybody on the call, what I ran up to when I was calling around lenders. I called several, and then I called Joe, and I was like, it was, okay, what's your experience in the last few years? And I'm like, well, I bought a multi-family apartment complex for 27 years at 2021. And so,
all right, well, let's.
Do you know I've been real estate construction since
So let's get back to okay. So let's get to the bullet points of the construction piece. Okay. All right. So questions and answers. I don't need story, as you know. So okay. So Okay, so the makeup of the group that's going to do the construction loan, is the majority borrower going to be 780 score?
Yep.
Okay. Now, what is their experience in the last 4 years in flips, rehabs completed for rental, or rentals acquired? So flips sold, rehabs completed and held as a rental, or rentals acquired. It's 3 questions, and there's a number to each one. There's not a kind of. So can we assume 4 flips?
For flips, they've done about 10 projects or more. I'll get his bio for you. He's a real estate investor in Hawaii and a builder in Hawaii. So
okay, that story doesn't. I don't care about the story. I care about just factual, completed projects. So let's just say 10 projects completed, right?
Yep.
Okay. And what's the balance going to be? Balance is going to be at least on the current balance is going to be around 700,000, right? You know. Okay. So you bought it for $1 million. Purchase for $1 million. 1 million. Then we're gonna go to the other moderators in a minute. Just 1 million and 700,000 on the balance, right? What's the construction cost? Construction. And what am I seeing after what's going to be there when I'm done?
So you see a single family home worth $5 million.
Yeah. Okay. And what's the construction timeline?
About 18 months.
So you need a 24-month bridge.
Yeah.
Okay, 24-month bridge. And again, this is down the road. It's not tomorrow. So it's nice to just kind of. So you're probably looking somewhere around 10% on rate, maybe in the high 9s at the time. And again, who knows? Right now you're between 9 and 10%. You're probably 1.5 to 2 points on origination. And they would take out the balance, the 700,000, and whatever else you got into it, or at least take the balance, and they'll probably fund up to 90% on the construction cost, because they're going to want you to have a little skin in the game. You know what I mean?
Yeah.
You're not going to get 100% financing in the whole deal just because the lender always wants you to know that you got your neck on the guillotine a little bit.
Right, that's great, though. I mean, if you're going to take out the first loan, then we're putting in 30% down pretty much on the.
Most likely. I'd have to run the numbers. I'm going to run the numbers with you today. And now that I have kind of a general consensus of what I'm looking at, the call will take about 2 minutes.
Yeah. So 50K, and we're going to like 1 million. I'll do that all day long, buddy.
Yeah, it's not bad. Good stuff. Well, Amy, not bad example. I appreciate your time. And are you having a room after this room or no?
Yes, so we're going to talk through. So I have a real estate technology room that follows this call, and it really kind of is like an ask me anything. Like we talked about AI for realtors last week. This week we're just going to talk about. It was a really cool room we had last week. And I had about 40 people show up, and what about this? What do I need to do next? So I sort of really example to I get to see the technologies are developed.
Good stuff. All right, so let's dive back into the next part of this subject on non-QM lending and real estate investor market update. This is Joe Screese, co-founder, co-host of the podcast. And we'll get to our next couple moderators as well. Non-QM lending and white label marketing outlook. And white label marketing is the broker side or correspondent side of working with a direct private lender. The demand for flexibility soars. Okay, so there's just not enough time to keep up with all the client inbound. You need bodies, you need soldiers. So the idea and opportunity for real estate professionals to diversify and white label is immense. We even have a social media team with Yordell Perkins of Perkatech, who provides all of that document, that paperwork and things that you need to be that white label marketed lender, and working with not just myself. There's other people out there and other options out there. Some people feel comfortable with one or two. People want to have 20, and that's fine. I think it's a little confusing. I think if you bury yourself into the sand with one or two, and you really get to have that relationship with that lender, things are a lot easier, and you realize what the differences are, good or bad, and what you're really trying to identify for your who you want to be as a direct lender. And obviously, their key loan types are typically DSCR, fixed to rent, fixed to flip, new construction, foreign national loans for the bilingual individuals that are here in any language. Foreign national loans are very unique. I don't speak a second language, so I am looking for bilingual white label marketers to market our products, to get it out there, whether it's for the fixed to flip, fixed to rent, DSCR. It's a huge opportunity. White label is booming. There's custom portals that you could put together yourself, and pre-built funnels and social media packages that could be put together, flyers and cards. You'll look the part. Branding, trust, and speed, compliance-ready assets. Right. The takeaway for non-QM space is maturing, and white label tools are now mission critical for professionals who want to compete at scale. Those who want to align with forward-thinking lenders offering white label programs will gain serious marketing and operating edge. We have a white label course every month. Our next one's coming up August 9th here in Philadelphia. Then in September on the 20th, we're in Lehigh Valley, and then we're somewhere else. We're taking it on the road for people to take advantage of these opportunities, and we're not charging. I mean, sometimes it's a $5 donation, or I just don't even charge. You know why? You make money when you close. Let's make thousands of dollars. There's a unique opportunity here for the real estate professional to create extra revenue stream and do it with ethics and integrity. Felix, good morning and welcome. Thank you for your patience. Brief overview, who you are, what you do, and thoughts to our discussion, non-QM lending, and the real estate investor update.
Grand Rising, Joe. Grand Rising, everyone. Felix Buchanan, Senior, the JLix Group, Buchanan Biz Enterprises, team leader of the Keller Williams Legacy team. Speaking with QM lending, as you said, the white labeling, I came to one of your classes. It's definitely something that we use in my world, obviously, because I deal with a lot of investors, as well as I'm an investor myself. It's definitely a full benefit, because just like you just did the little example with Amy just now, pretty much majority of the deals in which they're sent to you look just like that. Doesn't matter whether it's multi-unit, single family, commercial. It's pretty simple. What does your buyer qualify for in the sense of credit scores? Because that's going to determine what their interest rate is. Making sure that you do have all your ducks in a row with your contractors, just confirming what your rehab cost is. Again, the understanding what the ARV is with having a realtor, which falls into just making sure that you have a complete team of professionals that are going to be able to provide you the correct numbers, as well as you doing your due diligence to understanding what your material cost is going to be, what your contractor should be charging you, again, what your after repair value is going to be, what the return on investment is going to be. Because if those numbers don't make sense to you when we send that over, then it's a no-go on the deal. Obviously, credit score isn't the biggest thing, but the better the credit score, the better the rate you're going to get, the better chance that you have to only put 10% down versus putting 20% down. Always good to have the members within your LLC to have as high as possible credit score. Pretty much everything that you just went over with Amy is the criteria of which that I make sure that I qualify the people in which that I'm utilizing, as well as even qualifying myself. There's certain deals that I do that I just recently did a deal that we did on Chatham, and it was a business partner of mine, and we've done multiple deals. However, none of those deals had been within his LLC. It was in another LLC, and we had put money towards it. And because of the fact that he didn't have his name on any of the HUD ones, he ended up being at a zero rehabs within the last I think it was three. I'm sorry, 3 in the last 4 to 8 years versus getting the full 10 or 12 that had been done. So it's just best for everyone within that space. Just be mindful of just making sure that yourself or your buyers reach the proper criteria, but it's definitely an excellent tool for investors in 2025. And that's my wisdom and knowledge for today.
Well, Felix, thank you as always. And I look forward to seeing you August 22nd down in Baltimore. I know Shinny's rescheduling our Saturday event. So she's shifting it to later in August. So I will be down there as well in August to see you. But I hope to see you sooner than that.
He started college in 3 days, so he'll be already getting himself together, so he won't be here.
Man, you're getting old. All right. So Felix touched on something I want to make sure people understand. When it comes to fixed to rent and fixed to flip, strictly renovation loans, the most important questions, and guys and gals, you got to stay out of your own way with these questions and answers, okay? You have to focus on 3 questions. Fix and flips sold in the last 4 years. Fixed to rents, meaning BRRRR strategies, completed and held in the last 4 years. And rentals acquired in the last 4 years. Those are the questions and answers. There's not a kind of number. It's either 0 or a number. Now, I know there's some real estate agents down below. Well, I've done 100 transactions for real estate investors. Ladies and gentlemen, that's like walking by the gym and not going in and working out. Okay? That means you still don't have any experience in the eyes of a direct private lender. And I'm very sorry, but that's just how it works. And everybody starts at 0, okay? And there's nothing wrong with that. The only difference in that piece is leverage on the purchase side. All lenders in my space are giving you 100% of the rehab or construction, but it all depends on the purchase price and what your leverage will be. It could start at 70% or 80%, depending on credit or experience, probably most likely 80 to 82% based on experience and credit, and can go up as high as 90%, okay, on the purchase. And you're only bringing 10% plus closing costs. And the only change a little bit is on the rates for the more experienced borrower with at least 3 deals done is 8.99. If you're new, it might be 9.5 or 10, depending on credit. That's it. That's you got to have skin in the game the first deal or 2. And then all of a sudden it becomes a lot easier. So what do I suggest? Smaller, faster properties to turn around and stabilize to get that experience. Don't do the heavy rehabs for the first couple deals. Do a lighter rehab. Not lipstick on a pig, but maybe medium rehab or less. Replacing a kitchen or adding a bathroom or replacing a bathroom. Some light floor work, walls, maybe updating the roof, some landscape. You know, if you're buying something for $100,000, no more than $50,000 in renovation costs. So no more than 50% of the purchase price, the first 2 deals. Once you get past the second deal, then you can be a little more adventurous. Then the rates are going to be in your favor. The leverage is going to be in your favor. Now, when it comes to these larger, volume-based partnerships, and that's where the partnerships get a little weird, 9 times out of 10 or almost 10 times out of 10, when somebody presents me a partnership, somebody's coming with all the experience, but they got the shittiest credit. And then the individual that has the premier credit have no experience, but they want me to use the person with the bad credits experience to get the better leverage. That's just not going to happen. Not in my space. Maybe with a hard money lender, maybe. But a hard money lender wants their money back too. So the problem you're going to have is making somebody the guarantor that doesn't have the right credit, where there's really not an exit strategy. And to me, the exit strategy of flipping the property today is not as strong as it once was 3 to 5 years ago. So the flippers are becoming holders, and there's less flipping. And it's market to market right now. I mean, I know there's realtors saying they're doing absolutely great business right now. And I believe them if they're in very specific markets. And I know other realtors that are starving to death and taking on second and third jobs because they can't afford to be a realtor anymore. So pick your poison, but be realistic with expectations as a real estate investor and professional. Brian, good morning and welcome. Appreciate your patience. Brief overview, who you are, what you do, and thoughts to the discussion. Non-QM lending and the real estate investor market update.
Joe, how's it going? I'm driving home from a wedding. Can you hear me okay?
Yep, can hear you fine.
So my name is Brian Guth. My wife and I own LG Homes Group in upstate, or I should say Western New York. We do fix and flips, fix and holds, Airbnbs. And just kind of wanted to speak to what Joe was talking about from an investor standpoint and kind of non-QM loans. It's honestly probably the most used and strongest tool in my toolbox. I don't want this to sound boastful, but more of a case study. In April of 22, bought my first rental property as a fix and flip. And now, 3 years later, to 25 doors. And the way I was able to do that was through multiple tools, multiple avenues. On the lending side, it was almost exclusively through DSCR non-QM loans, and just speaks to the fact of how you can scale so quickly. You don't need to have all the money in your bank. You kind of just keep rinsing and repeating. And obviously that's what Joe's talking about. Just wanted to share that as far as it sounds great on paper, it sounds great someone talking about it. It can be done. It's not, obviously the scariest step is the first one, jumping in and doing it. Having guys like Joe on your side, in my specific case, my LLC, I was able to get a line of credit. So when Joe can, do my DSCR at 75%, okay, where's my rest of my money come from? It comes from my business line of credit. So get in, buy it, rehab it, refinance it, obviously pay my line of credit back, and boom, on to the next one. And in my case study, it was able to let me scale by 24 properties in 3 years. So just speaking to that fact, like I said, it can be scary. The first step is scariest, but it can definitely be done. Obviously, use Joe in your corner, bounce the stuff off him like we did earlier in the case study. But those DSCRs can really help you scale really fast. So I just wanted to kind of share that detail as I was driving. Back to you, Joe.
Brian, thank you as always. And Brian's a client, also a white label marketer, correspondent with Lendmark and myself. So we work closely in hand. And yes, you can absolutely scale your real estate portfolio using non-QM, non-qualified mortgage lending. And many seasoned investors do exactly that. Non-QM lending is designed for borrowers who don't fit the traditional lending guidelines, but still are very creditworthy. Okay, there's why is non-QM lending helping scale your portfolio or clients' portfolios? There's no DTI or tax return requirements. Loan flexibility. You could do multiple. There's no ceiling. Hey, can I do 3 loans at the same time? Sure. If you have the money to put down, why not? It's ideal for self-employed investors, those with non-traditional income streams. Higher loan limits. We don't really get caught up with if the deal makes sense, you make sense, the appraisal makes sense, let's close it. Okay. Easier to recycle. I have clients that will send me an application, and then I only need them to change page 2, and we send in the second and third deal. I have a client right now submitting 15 loans. He's like, hey, what do I got to do? I said, just change the second page on every one of the applications and just send me in each one by subject property. And we're doing all 15 loans at the same time. It's not a problem. I can't blanket them because they're all in different LLCs, and that's fine. But I offered him, listen, if you wanted to roll them all up into a master LLC, I could blanket them as well. Really? Didn't even know that. And this is a guy that owns 150 properties. Unlimited properties. We don't really have ceilings, okay? There's no cap at 10 properties, okay? We have unlimited financing capability and buckets to do loans. And the closings are completely different. What I tell people, fixed to flip, fixed to rent, take about 20 days, 15 to 20 days, depending on the appraisal coming back. And then on DSCR, you're somewhere between 25 and 30 days. If the borrower wants to make it complicated, it's going to get complicated. But it's not really a complicated checklist. It's not a complicated process. And if you have a good processor in place, which I do, she's wonderful, with my correspondence as well as my clients directly. I think that it's a unique opportunity. I think that this DSCR portfolio lender is going to grow. I think there's a unique opportunity to do BRRRR strategy still, but keep it lighter and fat, and smaller. The short-term rental space, I personally think I see some successes from it, but I see harder work in it on the expenditures or the works that need to be done to the property. You're closing always in an LLC with non-QM lending. And the whole no appraisal or desktop appraisal for DSCR, I don't think that's going to happen unless the entire appraisal community changes over the next bunch of years. Partner with a non-QM lender that understands investment strategy. The white label marketing tools, of course, of scaling with partners or clients. It's very important. These are different things that you need to keep in consideration as a real estate investor and being abreast of that. When a real estate investor has not even heard of non-QM lending and they own 20 plus properties, I'm baffled. Like, where the heck have you been? What rock have you been under over the last 5 years? Anthony, good morning and welcome. Brief overview who you are, what you do, and thoughts to non-QM lending and the real estate investor market update. Anthony Capizelli, going once, going twice. I think Anthony's having a hard time getting in and out of the room. Not sure what's going on there. So we'll continue our dialogue here. Do I think mixed use is going to make a rally in the non-QM space? Yeah, but I don't think it's going to be that competitive. Right now, if you have a mixed-use building with a storefront and a couple of apartments, the rates in non-QM lending are like late 9. And I know a lot of lenders, local banks are offering like much lower rates, but they're also offering only 5-year resets which if anybody knows a 5-year ARM, I probably haven't done a 5-year ARM in over 8 years because a lot of people got spanked with 5-year ARMs and resets and adjustables. So in the non-QM space, I feel if the mixed use piece becomes as competitive as the 1 through 4 and the 5+ units, I think you're going to have a very big opportunity there. Now, new construction, I feel like in the 1 through 4 space, we're starting to see some business coming in. A lot of the developers are realizing that banks don't want to lend on construction in some situations, or they're kind of capped out, and they're finding our money inexpensive at this point or cost effective based on leverage. Most of my most experienced contractors were given money at around 9%. We're going like up to a certain loan to cost on what they have into the deal already or buying the deal for. So we're probably going to be a 90% median between purchase and construction. If you already own the land, you've done the third party work, you've done the dirt work, I'm going to do a reimbursement up to say 65 to 70% on that, what you have into the deal itself. I'm then going to provide up to 100% on the construction. And I'm going to escrow 12 months of payments on new construction separately from the construction number. I might tie it into what I'm reimbursing you on, what you bought the land for and things of that nature, but you're not going to go into a mortgage shock in a new construction loan. Now, remember, a lot of new QM lenders used to escrow for fixed to rent, fixed to flip loans, and that's kind of slowed down here and there depending on the circumstances of the deal. Most lenders at this point want you to make the monthly payments. They don't want to be a collection agency on the interest-only loans. On the DSCR loans, are there seasoning requirements still? We're going backwards a little bit. So DSCR on fixed, if you're looking to do a refinance, there are two, and people always ask me about that. There's 2 options. There's a 3-month option or a 5-month option. You could start the 3-month option on the 2nd month. You could start the 6-month seasoning on the 5th month. There is definitely a rate difference on max leverage. There's definitely a difference in the cost to close and origination between the two. Now, if you're in a 6-month rehab loan, then you have to do a 3-month seasoning product, cost of doing business. But if you have a 12-month interest-only loan bridge, it makes sense for you to wait And I would wait anyway because this market is shifting and rates are going to shift in your favor potentially by the end of this year, but maybe by a half a point. So, I mean, if you're in an interest-only loan, there's no rush. If you occupy the property, it's paying itself. So I'd be more caught up in monitoring the rate and allowing yourself to take advantage of seasoning of ownership and then getting a stronger appraisal with less questionability, and take the 5-month option instead of the 2-month option, if that makes any sense. I think a lot of people get caught up in the hoopla, but the smarter investor is watching the market, watching the rates, watching Mortgage News Daily, watching data to see if rates are going to be impacted, what's going on with the Fed, what's going on with the Trump administration. Non-QM lending is really everybody. I mean, I don't know anybody not talking about being a real estate investor at this point. But I mean, I really feel if you're looking from the inside out on non-QM lending and understanding and studying the industry, you're going to realize that's where you want to be sitting if you're a real estate professional, whether you're an agent, real estate agent, or a title agent, or insurance agent. The most activity is with the real estate investor. Some final thought? Yes, go ahead, Amy.
I was just going to say, I know you're doing final thoughts, but an article out the other day about the Genius Act or whatever, where Trump is going to allow people to use their 401ks other than for traditional investments like stocks and bonds, and they can do alternative investing. That would do real estate investors for sure. If someone can use their 401k to do real estate investing, then that just open up the whole really different scan.
I mean, what was that called? The Genius what?
The Genius Act. Yeah. It's interesting. But yeah, it was a couple days ago, and Trump is thinking about, and it's for Bitcoin, for gold, any sort of alternative investment, people can use their 401k to do that with now. Supposedly, that's what he's trying to get with. See what happens. Probably.
Well, I can tell you, it'll legitimize non-QM lending at a national level overnight. It'll make it easier for investors and entrepreneurs to use alternative documentation for financing. I think that will force the Fed and force the rates down and improve terms by increasing competition and reducing perceived risk. And it might even encourage Fannie and Freddie to consider more inclusive underwriting guidelines. Because that's all regulated. So, this sounds like a broader movement to expand housing finance access. Many non-QM lenders probably already followed its spirits by accepting bank statements and offering DSCR products and working with self-employed investors. So I think that takes the gloves off. I really like that idea, Amy, and thank you for that additional insight. Felix, any final thoughts to non-QM lending in the real estate investor market update?
No, just within everything that we discussed, just make sure that you are very strategic as in anything else that we have discussed in the previous weeks. And just make sure that you know what you need to do to qualify. Make sure you know your exit strategies. These are very important pieces that go along with lending and having a team and everything else. Just make sure you do your due diligence with the way that things are consistently changing.
Yeah, and thank you, Felix, and I appreciate that. And that's why we have this subject matter, because I think this was a needed discussion today, just because we're in the summer months. People think it's quieter, and it's not. It's busier. I mean, I haven't slowed down. I haven't seen a slowdown. So I'm very blessed to see where this industry is going. I'm not saying don't take days off and get rest. You definitely need to set your boundaries, but it's unbelievable the amount of inbound inquiry that you got to keep up with and structure it as a real estate professional. So we're also going to start rolling out some personal development courses that tie in with the white label marketing, because I think it's a necessary evil, because a lot of people don't know how to market themselves for non-QM. or market themselves and feel comfortable and confident in the investor space. Like, everybody wants to be an investor-friendly realtor, but what does that really mean? And what does that look like? And what should you sound like? And what's your elevator pitch? So between now and the end of the year, we're going to put a couple other workshops together live that I think would be helpful for people to understand non-QM lending. And Brian, some final thoughts to non-QM lending and the investor market update.
No, so I have a bad connection here. I'm all good. Thank you, Joe.
No problem. So my final thoughts in 2025, non-QM lending is no longer an alternative. It's an advantage. As traditional underwriting remains rigid, the non-QM space continues to thrive, giving real estate investors unmatched flexibility to scale, refinance, diversify. DSCR loans, bank statement programs, and no income verification options, investors are breaking through barriers that once slowed growth. Short-term rentals, multifamily acquisitions, fix and flips, and cash out refis are all being fueled by creative and fast, accessible funding that meets the needs of today's entrepreneurial investor. In a market where agility is everything, non-QM lending gives you the power to fund more deals, close faster, qualify smarter, not harder, scale beyond conventional limits. If you are not leveraging non-QM lending in 2025, you are not playing the full field. I want to thank our sponsors, as always, Lendmark Capital, where I'm a senior loan analyst providing nationwide asset-based lending and non-QM lending. I'd like to thank Mr. Jarl Perkins of Perkatech, who provides the social media, architecture and design, and podcasting capabilities of the Creative Birth Strategy podcast, as well as white label marketing products for real estate professionals, as well as social media tools and programs for people for their websites, flyers, cards, graphic art design. We just did some major updates to our websites. We're also putting a new video together, which will be rolling out for, I think, the next one. We are celebrating our 120th episode as well of this podcast. I'd like to thank MB Capital Solutions, where I am a referral partner providing unsecured business lines of credit, which ties in to what non-QM lending is all about. And I've been a referral partner for MB Capital for 10 plus years, and a colleague of Eric Moss, the owner of MB Capital Solutions. I'd like to thank Realty 411 with Linda Pelagas. She pops in here once in a while. She provides national events and a national publication for real estate investors and professionals throughout the country. We've collaborated in the past on many events. Look forward to working with her hopefully in the future on additional events as well. I do want to thank TCS Property Management, where my licenses are held in Philadelphia. And we are now hosting our events with them down there, second Monday evening and a second Saturday morning of the month. And we had a special evening just this past Friday on the rooftop, featuring a new speaker there and having a grand opening to that event there. I just moved my New Jersey real estate license to Realty Solutions of South Jersey, where that's another property management company as well. And I want to thank the Real Estate Mastermind Strategy Group, where I'm now hosting events throughout many states and sponsoring many events. And if there's an opportunity to collaborate or sponsor one of your real estate investor events in your state, let's talk about it. Let's get to it. Let's make some money together and collaborate and make money for others. And that's how it all works. And listen, we're going to try to put the best subject matter at hand in front of people. Now Amy's jumping on board with providing a follow-up room to this room we have every Sunday morning, 9 a.m. I have scheduled subject matter out right now till December 1. So if there's a subject that we're not covering, please reach out to me directly, not on here, but directly. Let's have a conversation and try to make that happen. And I want to thank everybody this morning for their engagement. I didn't look at the chat at all this morning because I've been so engaged with our moderators. My quote this morning: don't worry about failures. Worry about the chances you miss when you don't even try. I want to thank everybody. Have a great Sunday morning. Have a great week. We'll be back here next Sunday morning with another great subject with great moderators. And have a beautiful Sunday afternoon with family, friends, and whoever you need to hang out with. Have some fun. And we'll end the room in the next 30 seconds. And thank you.
Blessed Sunday, everyone.